Hi, very good morning, ladies and gentlemen. This is Sai Ting here, the new macro analyst for Phillip Securities Research. Today's topic is actually on Singapore macroeconomic outlook. So, just a brief update of the agenda. We'll be going through the global markets first before we dive into Singapore macroeconomic outlook, and then we'll take a look into the Singapore equities market as of 2015, a recap of what happened in 2015, and uh, an outlook of what will happen in 2016, hopefully giving all of you a better picture. So moving on, um, okay, for us to understand our Singapore market better, it's always good to have a sensing of where we are today in the world. Of course, we'll be looking into the four major economies that's driving economy that's driving the world today, mainly the US, Eurozone, Japan, as well as China. So looking at US here, you can see on the screen, um, something big happened in December 2015, which is the long anticipated rate hikes that happened on the 16th of December. So after a decade long of near zero rate interest, the Fed have actually increased the interest rate by 0.25%, and therefore signaling a turn in cheap money, meaning as we go on, we'll be seeing a interest rate hike. According to survey done, they are saying that there will be four such similar hikes coming into 2016 this year, which will bring us around 1.25% of interest rate by the end of 2016. That isn't so much of a concern now, as this has been anticipated since the start of 2015. But what is of concern is actually the trajectory and the pace of the interest rate increase. Because essentially, if the increase becomes too sudden or too fast, it might potentially extinguish this recovery of the US economy, causing a fallback into the recession. However, our Fed chairman, the Fed chairman, Janet Yellen, have actually reassured the market that the Fed will continue to monitor this as they progress along. So, looking into this outlook, actually, US is actually quite an uncertain environment, and uh, we do not yet have a sensing of what will happen when the interest rate starts increasing even further. Okay, let's take a look at the second economy, which is the Eurozone. Eurozone actually showed a very strong recovery in early first half of this year. However, actually flattened through during the second half. This has actually been experienced throughout the bloc, which is the core economy as well as the peripheral economy. I mean, it's not just the weaknesses in Spain, Portugal, or Ireland. Actually, in fact, these peripheral nations are actually doing much better than the core. France nearly went to a technical recession. They had a contracting GDP in Q2 and managed to just barely scrape past in Q3. We are looking at the Q3 numbers currently as the final data for the full year of 2015 is not in yet. So we'll just mainly be talking about Q2 and Q3, generally Q3. So going back to Euro, the weakness in the external demand has actually escalated to the industrial production, and that's where we see the slowdown. However, we also see a stronger consumer and public spending as it supports it. Yeah. And to help even bolster the economy, sorry, sorry for the interruption. There was just some technical difficulties. Getting back to the Hopefully you guys can hear me clearer now. And yeah, there were some noises at the back. Yeah, we shall continue. Looking at the policies that the Eurozone has actually put into place, it's actually loosening policies, loosening monetary policy, which is very different from the US. So US is on the tightening monetary policy stance, whereby they are actually increasing their interest rate. The Eurozone, on the other hand, is actually loosening their monetary policy. They are currently extending their ongoing asset purchasing program by a further 6 months until March 2017. So Mario Draghi, the chairman of ECB, has also indicated that they are in favor of even creating a more loose monetary policy if needed to. So you can see a divergence in the monetary policy now. Let's move on to Japan. So we are now all having a brief discussion on what's happening in these four major economies, just to re-emphasize before we go into to Singapore. So in Japan, the economy itself, they are actually fighting hard against deflation as well as a contracting GDP. Same as France, in Q2, there was actually in a contraction. The GDP was actually contracted, but managed to avoid a technical recession in Q3 when there's a revised upwards of their GDP growth. So although the Japan economy has been doing quite badly, however, you can see that their equity markets have been one of the better performing markets in 2015, in fact. Yeah. The Abenomics three arrow of monetary easing, fiscal spending, and structural reform is taking place, and that's quite crucial in the revival of the Japan equity market in recent times. Yeah, and not only that, we could see that actually the Japan pension funds are actually buying into the market. We see outflow from foreign capital, but then this being propped up by the equity market is actually being propped up by the Japan pension funds. So Japan as well as Euro is the same thing. They are looking to in the past few meetings that the BOJ had, they have actually disappointed the markets a bit by not introducing new stimulus package. However, if we do see that the current economy is actually failing to respond to the current monetary policy, easing policy, and this really puts pressure on the chairman Kuroda to do something about this. So likewise, like I mentioned, in this G3 economy, we see US tightening, Europe is actually loosening as well as Japan. So it's what we consider a divergence in the monetary policy. It creates a lot of uncertainty, and yet quite an interesting time as markets are actually dislodging from their movements. Okay, moving on to China. Okay, China is going to end 2015 with a GDP growth rate of expected GDP growth rate of about 6.9%. This will actually fall short of their 7% annual growth rate that they targeted earlier this year. The story of China here is actually they're moving from a manufacturing-driven economy into a more of a service-driven economy. They are trying to be less dependent on their export and more dependent on their domestic consumption. So what we see here is actually a transition of China growth engine. They are trying to change their manufacturing export-driven economy into a more of a domestic consumption kind of economy. It's a delicate balance as we see how the Chinese government is going to balance the near-term economical performance along with this longer-term structural reform. That being said, China as being one of our largest trade partner actually is very instrumental in how their performance is actually very instrumental in how we perform as well. Okay, going to the next page here, we can actually see the Q-on-Q seasonally adjusted annual rate of return. So what am I trying to depict here is actually we are all in a very low growth state. The highest growth we have actually experienced was actually from the US in Q2 2015, which is a 3.9% growth. But other than that, most of them actually is below the 2% annual growth rate. And how does it affect Singapore in the sense that Singapore economic outlook will be clouded by the global uncertainty. And like I mentioned, the diverging policies as well as the lift off of the US interest rate will actually we will still see a increase in the interest expenses, and we will see the repercussion of how the increase in the cost of doing business will affect all of us. I mean, to point out as well, this for what's so interesting here is that the four economies are very much driven by policies, government policies, monetary policies. It is, in our view, not driven by fundamental growth. If you see in the US market, there's still a lot of buybacks that's happening. In the Japan, the equity market is being propped up by the pension fund, the Japan National Pension Fund. The euro is very dependent on the ECB easing their monetary policy, their asset buying program, purchasing program. So all we can see here is actually a market that's quite artificially inflated, and a lot of this is being propped up by government's intervention. This would be the same for Singapore as we move on into the Singapore economic review here. So this is for Q3, like I said, again, the number for the full year of 2015 is actually out. The advanced number is out. I'll share with you guys later in a while after I finish these slides. So for Q3, growth is 1.9%. Manufacturing actually contracted by 4.6%. Tourism-related activity gained traction, and this actually have a spillover effect in the domestic retail sector. To sum it up, MES expects full year growth of 2015 to be 2%, and for this year, 2016, to be between 1 to 3%. It's very clear on the graph on the right that manufacturing has actually dipped further. In fact, on the numbers as reported earlier today, let me just dive into the numbers that actually came in earlier today. What we are expecting is a full year 2015 to be at a growth rate of 2%. And the 4Q 2015 was actually at an astonishing 5.7% Q-on-Q growth. So that's quite surprising. I mean, digging deeper into the numbers, we actually see manufacturing further decline by 6% Q-on-Q. So, I mean, if you can extend the blue line on the graph to the right, you will see it fall even further down to the 6% mark. And on the what actually helps better Q4 2015 for Singapore is actually the construction sector as well as the service sector. I mean, both grew by 7% and 6.5% Q-on-Q respectively, and on a year-on-year basis is about 2.2 and 3.2%. All this being said, I mean, it translates down to Singapore hitting a 2% target this year. So nothing to add more on the economical review, but however, I'd like to share this part here. So what has happened in 2015, we're actually experiencing very slow growth. Actually, you can see our market is not performing very well. I will go on later to share with you what's the market, our equity market outlook. But looking at the Singapore economy, you can see that the government consumption actually increased by a lot. What does this mean? That it's actually in 2015, Singapore government have expanded their physical spending. This was actually reported in the MAS in the MAS reports as well. They are spending up to 50% of their net investment return alone in 2015. It was written earlier in the April 2015 budget. Yeah. In part, this was for the SG50 as well as for the pioneer generations, and in other part as well, it's actually to support infrastructure growth as we transit into a more of as the government is actually placing us in more of a technological country, a nation, and therefore there's a lot of investment there. Just to cite a few examples, how government have actually propped up this the economy. Like I mentioned just now, construction sector was up about 7% Q-on-Q. This is mainly in the public infrastructure space. And what we can see in the public infrastructure space is actually spending on the Thomson East Coast MRT line, just to name a few projects that the government is actually working on, as well as the Changi Airport Terminal 4 and 5. So we can see physical expansion and money channeling towards these few specific sector. Yeah, the infrastructure sector. Another area whereby the government is actually spending is actually in the domestic oriented sectors, which is education and healthcare. We will touch on that a bit later on this, and it's in line with our view as well. So if we go on to the next page here, we are talking about the labor market and inflation. So I'll brief through this. Unemployment remains unchanged at 2% for Q3, and however, the residential unemployment rate is up to 3% from 2.8 in Q2. And you could see here once again, manufacturing is actually shedding jobs by 4.3k. This is on top of the 4.4k that of job cuts that happened in Q2 2015. So if you relate this back to what we originally have, manufacturing have continued to improve, and this is a slight cause of concern for us because manufacturing is also one of our major. Yeah, if you look at here, manufacturing is really one of our major contribution to our economy, about 19%. So besides manufacturing, all else, we have a tight labor market, and that's actually supported our wage inflation about 4.1% year on year in Q3. And inflation actually remained suppressed due to the low oil prices as well as the huge government subsidy. Yeah, like I mentioned, because of the expanding fiscal policy, the actually suppressed price down. But as we move on to this year, we will start to see this one-off effect fading, and inflation would increase. According to MAS, expected core inflation is up, will be between 0.5% to 1.5%, and the CPI all item inflation to remain relatively flat for 2016. So the core inflation actually exclude energy price and the food pricing. Yeah, the more volatile pricing, and therefore 1.5 seems like a decent number here. Next, we move on to equity market. I guess it's no surprise for all our investor in the equity market. STI underperformed global equity index in 2015. An interesting fact, STI is actually ranked among the 20 worst performing index of a group of 93 major index around the world. So yes, there's no doubt we are one of the worst performing market with a negative return of with a negative return of 14.5. And before we move on, just to add to this, I mean, a colleague just shared with me earlier this morning that our fundraising, our capital market fundraising isn't doing that well either. The report came out, only 13 listings done this year, in 2015, and one on the main board. This is surprisingly low, especially if you compare this with 2009, right after the global financial crisis, and 1998, right after the Asian financial crisis. So we are at a juncture whereby there's a lot of uncertainty in the Singapore market, and yeah, and therefore we actually decide to have a more defensive stand, which we will talk about it later. So back to the review here in Singapore equity market, the STI itself, the financial sector was the most beaten down sector, averaging about 10% return in 2015. If you look at our big boys, our big three banks, DBS, OCBC, UOB, their return, I mean, you can see it on the screen, it's all in the high teens of negative returns. And within the other STI component, only SETS, ComfortDelGro, Hong Kong Land, and CapitaLand managed to have a positive return for 2015. So like you all know, STI is a 30 component index. If we were to take a broader picture, looking at a bigger picture here, the FTSE ST All Share Index, which represents actually a broader market. It has about 166 components, but it represents about 98% of our Singapore market cap. The story is similar here. We see a negative return of 13.9%. So I mean, I don't think I need to re-emphasize this as all of you know that Singapore market for the last year, 2015, hasn't been doing very well. Okay, so what happens after the dip, the 15% dip? We can see actually valuation has become cheaper, particularly the price to book. Price to book ratio is now at 1.15%, and that is below the one standard deviation of the long-term average. Yeah, and for price earning, it's averaging about. It still seems a bit expensive, a bit above the long-term average, but it's averaging about 13.3 times historical PE. Okay, for what does this imply? This implies actually, I mean, for any value investing or someone that would want to look into to buy at value, there should be a pocket of opportunity here, and that would create a slight rebound in the market for the start of 2016. But we don't believe that this would last any longer, as fundamental sets into play. Yeah. Therefore, this is our call for the next 6 months. With the uncertainty in the global economic outlook, we prefer to stay defensive within the healthcare and consumer goods sector. Why these two sectors? Basically, they have performed well in 2015 on the market cap weighted average. They have actually turned positive within the 10 ICB classification in 2015. We'll get to that later. So why have they done well? It's actually quite simply it's in the nature of their business. When they're providing such essential goods and services, they have been um, they will always. I mean, if it's essential goods, no matter what, you still need to eat. Your food will be there. You know, when you're sick, you still have to go and see a doctor. Your healthcare will be there. So these two actually have been performance have performed quite resiliently in this downturn. Yeah. For REITs, we have a few advice here. We're actually advising investors to go with a stronger balance sheet, and as we see, our coverage for. Sorry, give me a minute. Hi, sorry for the interruption. There were just some announcements going on within the office. Let us continue. So for REITs, we are advising people to look into from a bottom-up approach, looking into a strong balance sheet and a longer fixed rate in their debt financing, such as First Reach, which is actually within our coverage, and Soy Build, business space REITs. Okay, that have actually come to the end of our presentation, but just to go back um, one more back to the sector average. So if you look at this table here, we're actually seeing the ICB industrial classification, like I mentioned just now. So what happened in 2015 was healthcare and consumer goods are actually the better performer. And the companies involved here, you can see for yourself, 24 companies within the healthcare, according to the ICB. This is not my classification, this is ICB, which is the international classification benchmark. Yeah. Um, I guess I think that's it for me. Be happy to answer any questions.
For consumer goods sector, yeah, by the way, Happy New Year. This is Lindsay, the analyst covering consumer sector. So, for consumer sectors, we are bullish on OSIM, which we have recently updated uh, the call rating to buy from neutral. Based on the valuation, you can refer to the latest report published on early of December. So we are actually expecting turnaround for OSIM side, supported by the TWGT business. And besides OC, we are also positive on Tongyin Baifei, which is focusing on retail which is actually a proxy for retail play in China, and as well as Sheng. For these two, they are supermarkets players, and no matter how bad the economy is, you still have to buy your daily necessities and all. So basically, we are looking for cash flow accretive stocks as well as those more defensive stocks.
Hi, this is Sighting here. Just to answer another question that's actually on the question was asked, do you foresee any government stimulus introduced in the coming budget plan? Uh, what we do see, I mean, based on our expectation, is that the government will continue to spend on education as well as medical. This is in line with uh, their budget in 2015. So we don't have any sensing, but I mean a smart guess would be they will continue to invest in this area. Uh, from basically, if you look at the ministry, they have actually placed two ministers within the education ministry. And for others kind of stimulus, you'll be looking at I think it's going to be the same thing, like the transport infrastructure that we're seeing, the Thomson East Coast Line as well as the Changi Airport Terminal 4 and 5. So we will still see continuous spending within this specific sector. Yeah, but I think for the rest of the budget, we will have to wait until April where the government comes up with budget. Okay, I've got a question here on the market outlook. Generally, is STI still a buy, and are we going or Euro and US index the better way to go? For us, quite simply, we are very neutral on all market. Like I mentioned, a brief introduction into the global market outlook just now. It's an interesting time as we see diverging in the monetary policy. We can't say for certain whether the US would pick up. And as you can see this morning, the Nasdaq futures is already heading downwards together. I mean, it's the same as the STI. So until the dust settle, we take a very neutral stance to all markets. I mean, on the long term wise, uh, there isn't any call for us at this moment.
Hi guys, Hong here. Happy New Year to all. So we have a few questions on REITs and the property sector. One of them is whether rising interest rates will be a threat to SG REITs. And then some other questions on whether REITs are at a good valuation now to buy. So what I see is that for REITs, rising interest rates definitely will be a very strong headwind for the sector. No doubt a lot of REITs are still very comfortably in the mid-30s gearing ratio, but REITs being acquisition plays, rising interest rate environment would definitely make it harder for them to find yield accretive targets. And then that being said, that is just one side of the story as well. And then if you look at the individual sectors for the REITs, if you look at retail, if you look at office, retail side, if you look at the retail sales for Singapore for the entire year, for most of the months we are either flat or we are negative. That is excluding motor vehicle sales. So most of the months we are actually very propped up by motor vehicle sales. And if you exclude that portion, we are actually flat or we are negative. You look at the latest one, October as well, excluding motor vehicles, we're actually down 3 or 4%. So So that actually signifies that the retail side consumption spending is pretty sluggish, except for maybe July and August where we saw a big influx of tourists. And then for the office side, we are seeing a huge ramp up in supply this year, which is more than 3 times the annual take-up rate for the office sector. And then coupled with the increase in supply, we also have declining demand over the past few years. You saw all the news about the retrenchments from all the banks. You saw the likes of Stanchart, Deutsche Bank, HSBC. Everybody is going through restructuring. Everybody is cutting. No financial institutions are not expanding as fast as we would like them to be. And then demand for the past few years, they've been primarily from the IT sector, your Facebooks, your LinkedIn's. So all this will pose as very strong headwinds for the office sector, despite the fact that a lot of them are already trading at 0.7, zero point 0.8 times book value, which some of the houses are already calling them to be attractive. But I think there is still some way down to go, because if you look at developers now, some of them are trading at half 0.5 book value. So what's stopping 0.7 or 0.8 from going down further? And then so for our REITs coverage, we actually are more focused on a lot of them which are more overseas exposed. First REIT, your Capital Land Retail China, your Croatia's, and then within industrial we are more optimistic on a specific the business park segment, like soil built business space REIT. So as a whole, the sector is actually yielding about 6.5% currently. Average for the past 5 years is about 5.5%. So at 6.5%, it might look like it's a pretty attractive yield. But we have to remember, we consider this sector yield as two portions. One of them, you look at the Singapore 10-year risk-free rate, and over the past 1 or 2 years, that rate has actually risen quite a fair bit. From over 1% to now is about 2.6%. So that is one component of it, the risk-free rate, and then the second component is the spread over the risk-free rate. So now that the risk-free rate has risen about 1% over the past 2 years, increasing the sector yield should correspondingly go up as well. And to add to that, the spread over the risk-free rate should increase in more uncertain times like now where we have uncertainties over the property sector. So these being said, 6.5% sector yield now versus if you look at 5.5 for the last 5 years average, it may look attractive, but it is in fact to compensate for the higher risk-free rate and the higher spread that should be allocated to the sector as of now. So I wouldn't say so. There are questions on whether CMT and Fraser's Commercial Trust are considered buys for 2016. We don't have actual calls on those two REITs, but what I can tell you are all the sector general outlook that I have just mentioned. And so for CMT, you have all the regular retail spending, sluggish retail spending to be concerned about. And Fraser's Com will be more of the how their office buildings will be affected by the upcoming supply. So I would say if their office buildings are more located, because there's an increasing shift towards the suburban or the non-CBD office spaces, this trend. So we have to see how the office buildings are affected by the upcoming supply within the Marina Bay region. And then so this increasing interest rates environment is also going to be a threat for the property sector. And but that being said, a lot of developers have dropped to levels which are what we see during the last GFC. Like you see your Hobie is already trading at 50% book. Right, so Capital Land is about 0.8. So the possible catalyst for this next year could be if the government retracts some of the cooling measures. So that could boost transactions volume by a bit, but I think prices will still be going down because of the increase in supply, especially in the mass market segment, and the drop in demand because of the structural change that the Singapore economy is going through. So we are not depending on foreign labor influx as much, and we are depending more on productivity driven economy. So this kind of the foreign demand that we've seen for the last 5 years, or in fact from 2009 until maybe 2012, we will stop to see we will not see as strong a demand from the foreign labor side. And so possible catalysts as mentioned would be if the government retract some of the cooling measures and if the interest rate increase is not as fast as forecasted. As for individual property stock picks, we are still in the midst of looking at them and initiating coverage on them. So do look out for them in the next few months.
Okay, I think we've come to the end of the webinar. If you don't see any further questions, thank you, and we'll see you next week.